Hello out there, everybody. As you know, our regularly scheduled meeting in Principles of Accounting has been canceled, so we are taking this one to the internet, and we'll do an online lecture today. If you recall, in our last meeting, we began Chapter 5, which deals with accounting for a merchandising operation, like a Walmart or a Target or an Abercrombie & Fitch. It's basically a retailer who's going to either make a good or buy a good from someone else and then resell it to the customer. So we got into a couple of things last time that's kind of unique to the merchandising world, and we kind of focused on purchasing inventory, and we talked about what we need to do if we get a discount. We talked about what we had to do if we had a return and maybe we bought inventory that was substandard or defective and we had to send it back. And then we talked about how to handle shipping costs. So we did all of that in our last meeting. Today, we're going to focus on the other side of that coin. We're going to talk about selling inventory. We're going to talk about what happens if we are the ones giving the discount to the customer. And we're going to talk about what happens when a customer returns a purchase that they've made. And then we'll wrap up today talking about adjusting inventory. What do we do if our inventory has disappeared? So that is kind of what's on the agenda for today. It's going to take about 3 or 4 journal entries. We'll learn a couple of new accounts, and then hopefully by the end of this part of the lecture, you'll be able to do all your homework for Chapter 5 and Connect. So here we go. If you remember from Solid Footing, every time we sell a product as a merchandiser, we have to make 2 journal entries. And the 2 journal entries that we make are basically recording the asset that we get and the revenue that we've earned. So that's journal entry number 1. We record an entry for the asset, either cash or account receivable, as a debit, and then we credit our revenue account. We have to make that entry every time we sell a product. The second entry we have to make is basically recognizing the cost of what we've bought, or what we've made, that cost of the inventory. So that involves a debit to cost of goods sold and a credit to the inventory account. Every time we sell a product, we have to make both of those entries. So we'll review that real quick. We have on November 3rd, a company named Z-Mart sold $2,400 of merchandise on credit. That merchandise has a cost basis of Z-Mart of $1,600. So again, we have to make one entry to record the revenue and the asset we get. We have to make a second entry to record the cost of goods sold. This would be your first entry. This would be your second entry. So I'm going to go over here. We'll just make a little journal entry. We sold $2,400 of merchandise on account. When it's sold on account, that means we sold it on credit. And we said our account, as you know, to record a sell on credit is accounts receivable. It is an IOU basically. And then for our credit, we would record sales revenue. We have done that entry so many times, you are probably sick of it by now. Or maybe you're just sick of accounting in general. I don't know. The second entry, we got to record the cost that we had paid for that merchandise and take it out of inventory. So we need an expense account called cost of goods sold. And as I always say, your expenses are almost always going to be debits. And our credit would be to inventory. $1,600. So that is our entries, or those are our entries, I should say, if I want to be grammatically correct, to record a sale of merchandise on account. First part, we record the sale. Second part, we take it out of inventory and recognize the cost of that inventory. Okay, so that's where we've been. Let's move into new uncharted territory here. Let's talk about sales discounts to begin with. When we talked about buying inventory, we talked about how sometimes a vendor will give us a little break on the amount we have to pay for what we've bought if we pay in cash within a discount period. And that kind of encourages people to pay so they can turn an IOU, an account receivable, into cash in their hand. I can't pay my bills with an IOU. I can pay them with cash. So generally speaking, I would rather have cash than an IOU or an account receivable. It's the same on our side. Sometimes we will give a discount to people to encourage them to pay early. So I got a couple scenarios up here. It says Z-Mart completes a $1,000 credit sale with terms of 2 10, and 60. Now, just like before, those credit terms, they mean the exact same thing whether we're buying or whether we're selling inventory. So if you take a look at 210 net 60, you remember the 2 is the percentage of the discount that you're getting. 2% discount. If we pay within 10 days, we have to pay within 60. So if our customer pays us within 10 days, we're going to give them 2% off of that invoice price, which might be a pretty good deal. In this case, the account was paid in full within the 60-day period. You can see we sold on the 12th of November. They didn't pay till January 11th. So they don't get a discount. So when we collect that cash from them, we simply debit our cash account and then credit the receivable account, and it goes away. We don't have to mess with any discount there. So what happens when we do have a discount? It says Z-Mart completes a $1,000 credit sale with terms of 210 and 60. The account was paid in full within the 10-day discount period. So we've already seen that entry for the $1,000 credit sale. It was on the slide before. Let's just focus on what happens when they pay us within that 10-day discount period. So I believe the sale was on November 12th. We'll just say they paid on November 20th. They paid 8 days later, so they are eligible to take that discount. Okay? We know we're getting cash, so we know we'll have a debit to our cash account, and we know that they're paying off an account receivable, so that receivable is going to go away. Okay? Now the question is, what are the numbers involved here? The amount they owed was $1,000. That's the amount of the receivable that's going to go away because they've paid it, and they've paid it within the discount period. So now what we have to do is figure out the amount of cash involved. They owed $1,000. They get a 2% discount. So essentially, we'd be looking at 1,000 times 98%. 100% minus a 2% discount gives us our 98%. So if you do the math on that, you'll get 980. That is the amount of cash that they got. Or that we got, I should say. So I have a debit to cash for 980. My cash went up $980. That was the amount of check that we received. And then I have a credit to the account receivable account of $1,000. That makes that go away. So you're probably looking at that and you're saying, well, wait a second. One of our accounting commandments is that debits always have to equal credits. And that's true. So we need to do something else to make that balance out. We were supposed to get 1,000. We granted a 2% discount. So we're going to make a debit to a new account called Sales Discounts. $20. 1,000 times a 2% discount would be $20. So we collected $980 in cash. We gave a $20 discount, and that receivable goes away. So we actually have a new account here to keep track of all the discounts that we're given. Okay? And that is always going to be a debit. I can't think of very many circumstances where you'll have a credit to that account in Principles of Accounting. So that's how we handle a sales discount when we collect the cash and they've paid within that discount period. So if we're taking a look from a T account standpoint, I'll just make a little T account for my sales revenue. In that particular example, we had a $1,000 sale, and then we had our new account, Sales Discounts, and we booked a $20 debit entry to that account. If we're taking just that one sale and assuming that's the only sale we had, at this point, we'd have net sales of $980. The $1,000 sale minus the discount that we gave gives me a net sale of $980. So this account, this discount account, is a contra revenue account. And you might remember we've talked about contra asset accounts, and we said that they're kind of the ex-wife or ex-husband of the accounting world. The only thing they do is bring someone else down or bring another account down. So the goal of the sales discount account is to bring down revenue. We had $1,000 of revenue, but with that discount, we really only had $980 in revenue. Okay, so that's a contra revenue account. Its main purpose is to just reduce what is really in the sales revenue account. We could also have returns and allowances. We sell something, the customer's not happy, they bring it back to us. And that's one thing that retailers are really kind of trying to figure out is a good return policy that people don't take advantage of. And you hear about some people that are going to Macy's and they'll buy clothes and kind of wear them and then maybe take them back a week later. So it's something that a retailer has to have for a customer, a good return setup, but it's also something that could be easily abused. So two things can happen. If a customer brings back merchandise, they just don't want it anymore, so they bring it back to us, and we have to learn how to account for that. And then also, maybe the customer is just unhappy with the merchandise. They don't really want to bring it back, and maybe we could just give them an allowance, a little break on the price, or give them some of their money back, or take some of the bill off of their receivable. So those are the two scenarios. They're handled exactly the same from an accounting standpoint. So let's take a look here. Sales returns and allowances. Recall Z-Mart's sale for $2,400 that had a cost of $1,600. Assume the customer returns part of the merchandise. The returned items sell for $800 and they had a cost of $600. So we have some inventory coming back into our store here. No problem. It's almost like when we sell inventory, we have to make two entries. We have to make an entry to record the amount that was brought back from the sale, and then we have to record an entry to put it back into inventory. Here's how this is going to look. The returned items sell for $800. So at one point we recorded a sale that included the $800 of inventory. That sale is now no longer. It's gone away. So we kind of have to reverse out the sale that we've made. Now we're going to have a new account called Sales Returns and Allowances. So we're kind of reversing out the original sale we made. I don't debit the revenue account because I want to be able to keep track of how many returns are coming back through the door. And I want that information to be separate from the revenue account. If I just made a debit to revenue, I wouldn't be able to separate what we sold with what was brought back. It would be a lot harder to do that. So I'm going to actually have a debit to an account called Sales Returns and Allowances. That's another of those contra revenue accounts, and that is a new account. We haven't talked about that one yet. So my credit is going to be to basically however the customer had paid. If they bought it on credit, my credit would be to account receivable. They don't owe that money anymore. If they paid in cash, I might also have a credit to cash from where I had given them that money back. So that's part one. The second part, we need to record the return of the inventory and put it back into our stockpile. So I'm going to debit inventory because we need to make inventory go up. Assets always go up on the debit side. And then I'm going to credit cost of goods sold. That inventory came back, so it's no longer an expense to us. Okay, so you'll notice in the second part of that entry, it really just looks like a reversal of the second part of the entry we make when we record a sale. Instead of having cost of goods sold as an expense and inventory as a credit, we kind of have inventory as our debit, inventory goes up, and the expense goes away, the cost of goods sold. That's how we that's how we record a return or an allowance. They're both kind of handled in the exact same way. To give you an example, this time we have a sales allowance. Assume that $800 of the merchandise Z-Mart sold on November 3rd is defective, but the buyer decides to keep it because Z-Mart offers a $100 price reduction. So all we have to do here is hit that new account, Sales Returns and Allowances, for $100. Then we'll credit, again, accounts receivable or cash, depending on the payment method that the customer used. We don't have to record anything else. We don't have to record a return of the inventory because the customer kept the inventory. It didn't come back. So this is really all we have to record. A debit to the returns and allowances account and a credit to the receivable or cash, depending on the method the customer paid with. So you might ask yourself at this point, if we have a revenue account and we had that $1,000 sale, then we had that discount contra revenue account, then we have a sales returns. I put that on the wrong side. Scratch that. We have a sales return and allowance account. You might look at that and say, well, why can't we just put our discount and revenue or sales return directly to our revenue account? Why can't we just debit revenue and not worry about having all these different separate accounts? And that's a good question. The reason we don't do that is, like I said before, we want to make sure that we can track the discounts that were given separately. We want to make sure we can track the returns that are coming back separately. If we just dump those into revenue, we lose that amount of detail. Okay, so even though we still end up either way with net sales at this point of $880, we like to keep the discounts and the returns separate because it gives us good information about what's coming back or the discounts that were given. Finally, we need to talk about shrinkage. What happens when inventory disappears? It's not like in the Seinfeld episode where Costanza was in the pool. We actually have a problem in retail. If you've ever worked in retail, you know sometimes what the computer says we have in inventory isn't actually what's in inventory. And a lot of times that's because stuff gets stolen. People come in, or maybe employees walk out with the product, and then when that happens, it doesn't get registered in the computer, obviously, that product isn't there anymore. So there's a phenomenon that we call shrinkage. We have less inventory than what the books say we have. When that happens, we have to make an adjustment to bring our inventory levels down. And usually that happens after we've done a count. We take what's on the computer, we print it off, and then we do a physical count and see how the two compare. Normally, you will have less on hand than what the computer says you have. It's a really, really simple journal entry. This is the last one we'll do, so hopefully you're still hanging in there. Z-Mart's merchandise inventory account at the end of the year in 2013 has a balance of $21,250. That is according to the computer. That's what our computer says we have in inventory. But a physical count reveals that only $21,000 of inventory exists. So there's a discrepancy. We really only have $21,000 worth, but the computer says we have more. So we need to make an adjustment to bring our inventory down. We said it was going to be at the end of the year, so 12/31. We need to make an entry, and it looks like we need to make it for $250. That is the difference between what is on our books and what the physical count said we had on hand. So what we're going to do is we're simply going to make an entry to cost of goods sold. That's going to be an expense, and then we'll debit inventory. So it's really just a pretty simple entry. It's just like recording the second part of a sale. We're recognizing an expense, and we're taking inventory down a little bit. So that's what we do when we have shrinkage or inventory loss. The final thing the chapter talks about, and I don't know that if it's in your homework or not, we have what we call a multiple step income statement that is used by a lot of retailers and merchandisers. You can see it starts with sales. We back out sales discounts, sales returns, and allowances and get a net sale number. Then we back off our cost of goods sold to get a gross profit. That gross profit number is really important because it shows basically how good we are at selling our goods, whether it be goods that we've made or bought from someone else, how good we are at selling that stuff for more than what we have in it. If your gross profit is negative, it's a gross loss, then you are in bad shape because you're not even making money to cover all the other expenses that you have. And then, of course, down at the bottom, you have a net income line. So that's really what we have in Chapter 5, gang. And as you're looking at your homework, it will follow that kind of those entries pretty closely. The biggest thing that you have to be careful about, and I can't stress this enough, when you're doing your Chapter 5 homework, make sure you read the question. Because normally you'll have two different companies in the question. One's a buyer and one's a seller, and it will ask you to make the entries for the buyer or the seller. If you don't read the question and you start making entries for the buyer and you should have been making entries for the seller, you're going to get all of them wrong. So make sure you know who you're dealing with, and if you're making entries for the buy side or the sell side. And of course, if you have any questions, I'd be happy to answer them. That's all for now, and we'll see you in class later on.